today. Stocks in the long run, of course, moving higher. How do you think, though, about in the face of all of the inflationary data that we got this week, what that sort of does signal for your world of equities?
We have to remember the inflationary data we got, CPI and PPI, is really backward looking. It was taken from the absolute peak of the oil prices, peak of gasoline prices. What was really important today, I think spurred that rally, was the come down of the inflationary expectation in the University of Michigan survey. I mean, we know that Jay Powell looks at those inflationary expectations. And although they came down in the Treasury market between the TIPS bonds and the standard bonds, they hadn't come down in inflationary expectations market. This is the first sign of that. And I think that that was a very, very important development today. And in addition, import and export prices were lower than expected. So the forward-looking news on inflation is looking much better, even though the backward-looking news is certainly very grim.
And that's what I want to fold together, Professor. When you take that backward-looking information, still very hot inflation, at least in the month of June, you think about those forward expectations for inflation expectations. How do you think the Fed is divining all of this and reading those tea leaves, as the big debate in markets right now is whether 100 basis points could be on the table this month?
Right. I don't think so, especially with today's data. You saw, you just showed a graph of the markdown, and Waller's comments that he is still for 75. Maybe Bullard will be for 100. He might dissent. I think there might be a dissent for 50 with Fed President George from Kansas City. So, but I think the balance is going to be 75 unless we get some, very bad news. Look, when we take a look at those sensitive prices, and this is what we really hope that Powell and the Fed is doing, home prices stop going up. Commodity prices going down. Even freight prices, which of course were the big bugaboo for so long, actually going down, both on the sea and on the land. So there's a lot of signs that an anti-inflationary policy is working. I think the market is worried, is the Fed going to go overboard? And if they're hoping that if they see that inflation is getting under control, forward looking, what really will spark the rally is when Jay Powell says, you know what, we're going to have an increase, and then we're going to look around because we think we've won much of the battle, even though we're going to get statistics in the CPI that are going to continue to show inflation. Down the road, we've conquered inflation.
Professor, I'm still curious about some other market signals here, and that is that inverted yield curve. What is it telling you, given that we're looking at a 210 curve that's still inverted at 20 basis points today?
That's correct, and you're absolutely right. If we go to the post-World War II period, inverted yield curves are the single best predictor of recession. Now, of course, you can almost argue we're in a recession now because this quarter GDP is called by most observers as negative. We've already got the print on last quarter's that is negative. I'm talking about first and second. We've gotten an early read on this third of 1.2%. That could go negative. We're in a mild recession already. So I think that negativity doesn't really disturb me that things are going to get that much worse. Furthermore, with interest rates as low as they are, with the long bond, and I don't think it's going to go much more than 3.25%. It's not like the days when it was 5, 6, 7. You inverted the curve, you went to 10. We're going to have a flatter term structure in the future. We're going to have more mild inversions that are not going to be indicative of a recession. So I'm not concerned about that. I think we're already in a mild recession. It shows that we may not have something worse unless the Fed overreacts. That's actually my main concern right now.
What then does that mean for peak 10-year yields at 3.25 just a few weeks, maybe a month ago? Is that behind us?
I think it is. I think we hit 350 as the high. I don't think we'll see 350 as a high anymore. I think that was when there was really concern. Well, is the Fed's policy working? Look what's happened to the dollar. Look what's happened to the money supply. I mean, I've never seen such a sharp slowdown. We've quoted what's happening to flexible commodity prices. The only market that's still tight is that labor market. And that's And we have to raise wages because wages are not keeping up with inflation. That will be a source of inflation in the service sector. The housing sector going forward, house prices, I think, are heading downward. Rental peak has been hit. And as we said, oil and sensitive commodities have already come down.
And Professor, I want to dig in on your point that your view that we're in a mild recession already. And I'm wondering what the read through to the equity market is when you think about things like that very tight labor market that you pointed out, as well as corporate default rates, for example, which are still very low.
Yeah, and I think honestly they will remain low, despite there was some, as you pointed out, increase in reserve losses by some of the banks. The truth of the matter is, with housing prices have gone up 40% since March of 2020. They may go down 10% now, but the amount of home equity, which is really the bulk of so many Americans' wealth, is still very, very strong. I mean, that's what really killed us in the financial crisis, 2007, 2008, is home equity just disappeared everywhere. And I think that is going to keep those default rates very, very low. The banks are going to be cautious, but my feeling is we're not going to see a lot of personal increases in default rates with the recession, the mild recession that we're having now, and the strong equity that's been built up, and the strong wage growth, especially at the low end. Middle end has not made up for inflation, but at the low end, interestingly enough, unskilled, semi-skilled have actually kept up with inflation.
Even if you don't believe that there's going to be a huge spike in defaults ahead, what about the fact that corporate America is so highly levered and interest rates are going up? What kind of problems does that create for corporate balance sheets and their ability to invest in the future?
Well, first of all, I hope, and I've been advocating, many of firms locked up long-term rates in the last 5 years on their financing. What is going up is short-term rates. And honestly, I don't think they're going to go up as much as we see December Fed funds rates, 3.5. People are talking about 4 or higher. That will not be punishing in this environment. I don't think corporate America is over-leveraged. I don't think a basic American is over-leveraged at the time. I think we have a world of difference from what we had in 2007. And I think we're even better off than what we had in the pandemic, where everything closed down for a period of 2 or 3 months.